I just finished doing the video on vertical spreads about an hour ago or so, and I thought, as I watched the end product, I'm not sure this is not confusing. I mean, it was almost confusing to me, but it's hard to explain. I think it might be better if I actually show it. So what you're seeing on the screen is Thinkorswim. This is my trading account. Actually, this is a junk account that I don't use anymore. I keep it alive because I have a couple of payments coming in automatically from other stuff. But this is a full margin trading account. And you need a margin trading account, by the way, to trade spreads, which is stupid, but because spreads are cash secured, basically. So I don't know why you need a margin account. I don't use margin. I never have used margin. Margin basically means you're borrowing money from the brokerage, which is stupid. Don't do it. So anyway, this is a margin trading account on Thinkorswim, which is a product of TD Ameritrade. When I first started this journey, I looked at about 4 different trading platforms, and they all had pluses and minuses, and I just liked this one the best. Plus, if you want tutorial videos, there's more videos on YouTube about Thinkorswim than any other platform. However, if I was going to do it over again, I probably would choose Tasty Trade, because the Tasty Trade or Tasty Works or whatever they're going by, their trading platform is extremely good and is geared more towards options than stocks. You probably could buy stocks on Tasty Trade. I'm sure they must allow you to, but it's just not geared that way. This just has a zillion features. You can day trade. You can I'm drawing a blank on the word. You can trade stocks, you can trade options, you can trade futures. You can also trade futures on Tasty Trade. They're very much into futures. Anyway, this is mine. So this right here is the my watch list, part of my watch list. This is what you call an option chain right here. This is SoFi. But let's go to, just for an example, Google. Let's actually set up a credit spread. I don't do debit spreads. I don't like them. But it's the opposite of a credit spread, so it's not hard to figure out. So here's the Google option chain, and these are the expiration dates you see over here. Let me get my square thing. These are expiration dates, and this number right here shows you how many days until it expires. Tasty Trade, by the way, has excellent videos. I'm only just going through basics. When you get to the part where you want to do intermediate or advanced, I recommend going to Tastyworks, watching their videos. They're just freaking awesome. There's no way I could compare with them. Anyway, this is the date right here, and this is the days until expiration. So if we open up, Tasty Trade recommends 45 days, I think is their thing. I kind of like doing shorter, but not too short, because if you go too short, that's a whole nother topic. Let's not even go there. Let's just pick, by the way, the yellow ones are the weekly expirations, and the white ones are monthly expirations. So monthly expirations typically, and maybe I'm wrong on this, but it seems to me they typically have better pricing. So here's another thing, which this would warrant a different video. This column right here is IVR, IV rank, otherwise known as IV percentile. This column shows the volatility of this particular underlying. So we're going to start with Google. They have a just under 60% volatility rating, which is pretty good. Anything over 35 is pretty good. So let's start with Google. Let's look at a 36-day. Let's look at a 36-day option chain. So Delta, I use Delta a lot. That's also another video. Option Greeks is another video. This is Delta. This is this column's implied volatility for that particular strike. This column is, geez, I forget. This column is, all right, I apologize for being unprepared. Anyway, I think this is, this is open interest. This is one of the things you look at to make sure that it's liquid, which is that's also another topic. This one is probability of out of the money, which is important, but you can tell the same thing by delta, basically. So going by delta, I would say 26 delta. If you're going to do a credit spread, if you want to do a naked put and you want to own the stock and you have the money to pay for the stock, and everything in options is times 100, remember, so one option contract equals 100 shares. If you're going to do a naked put, you'd want to get close to the at the money. In this case, you can see where it's grayed. That's at the money. And this is the strike price. Let me go back to this. This is the strike price right here. And so at the money here, up here, you can see the stock is trading. This is after hours, so that's why nothing is moving, and it's a lot easier to explain things when it's closed. The stock market's closed. So the last known trade was $91.13. Actually, we probably have to go. That's what it closed at. So we'd have to go to the chart to see after hours trading. Okay, it's still $91.13. Okay. So anyway, I don't know why this is showing 95 is at the money. I guess it is. 90's out of the money. So anyway, for a credit spread, I would go with 14 delta, because you can see that gives you an 82% possibility that this will remain out of the money. Now, obviously, it's not a guarantee. There's outliers. The market's been crazy the last year, so you might even want to go 7 delta. But the further away from the money you go, the less money you're going to make, but the less risk you're going to take. So this column is sell. So we're going to click. We're going to pick a 14. No, we'll pick a 14 delta. We're going to sell the 80 strike put. And then we're going to buy for protection the 75 strike put. So you can see there's $5 in between. Everything's times 100. So $5 difference between the two strikes really means 500. So your maximum loss, well, let's click over here. This is your credit right here. This is what you're going to make in premium right there. 50 cents. Now that's times 100. It's $50. Everything's times 100. So excuse me, when we click on confirm and send, it's going to show you right here the break-even stock price is $79.50. Let's move this out of the way if we can. Yes, we can. We can move that out of the way. So your maximum profit is the premium that you collect, which is right here, $50. The maximum loss is the difference between what you collect and the width of the spread. The width of the spread is $5 or $500. And so your maximum loss is $500, but you've collected $50, which you keep no matter what happens. You keep that $50, unless you lose. So the maximum you can lose is the $450. And your credit's 50. So if I were to hit send, which it's closed anyway, it wouldn't go anywhere. And TD Ameritrade charges 65 cents per contract. So when you do a credit spread, that's 2 contracts. So that's where that $1.30 comes from. So this is a credit spread. That's it. That's it. Now let's go to something with more volatility, because volatility is king in options. Let's go up to actually Amazon. Amazon's always been a good one. Amazon, let's pick something in roughly the same. We could go 13 or 22. I'm going to go 22 delta. That's a 73% chance of probability of staying outside the money. And you need this to stay outside the money. If the stock price drops to your strike price, then you're not going to make any money. So you want it to stay above there or out of the money. So we could even do 13. 13 is the same, roughly 82% chance of staying out of the money. So let's do 13 delta, which is an 80 strike. So we're going to sell an 80 strike, then we're going to buy a 75 strike. See, it's just a little bit higher. It's not much, 55 cents or $55. So what is the difference in price? You got $91 for Google and $95 for Amazon. They're pretty similar in price, but Amazon's a little bit higher in volatility, which explains it's only $5 higher for your credit. But same thing, if I hit this, my maximum loss is 445 because I've collected 55. Now, at the same time, I could widen the spread by buying the, let's say I buy the 70 instead of the 80. Now I'm collecting $87, but my risk is $1,000 because there's $10 in between the two strikes. So you'll see that here. I'm collecting 87, but 1,000 minus 87 is 913, not counting this little fees. So that's a credit spread, and the same thing works in a call spread. If I go up here to the call, this is the call side on the left. If I pick the same, well, it's not going to be exactly the same delta. It's going to, let's pick a 19 delta. That's an 84.6% chance of staying outside the money, and let's sell the 110 call, which is 19 delta, and we'll buy the 115 call for protection. So again, that's 59 cents. It's 4 cents more. You're collecting 4 cents more than you would with roughly the same delta on the put side. Now here's something cool. This is called an Iron Condor. What if I did both? Why can't I do both? Well, I can do both. So we'll stick with this 22 delta. No, we're doing 13 delta. So now I'm going to sell the put side too. So now there's 4 contracts instead of 2. And now I'm collecting $1.14, which is $114 instead of 50. And you'll see it here. So now my maximum loss is 386. Now, as long as we're here, I think this pretty much explains it as well as the video I posted an hour ago. This is called an Iron Condor, as you can see right here. This strategy is called an Iron Condor. When you do a credit spread on both ends, it's probably also called an Iron Condor if you were to say delete. If I was to do a debit spread, which would be stupid. You wouldn't want to do a debit spread on both ends because it can only move in one direction. So you're going to automatically lose one direction. Obviously, in a credit spread, you want it to stay in between. If you're selling this strike and selling this strike, you want it to stay in between these two strikes, and that's where you make your money. And then you've got, that's a whole nother video too, time decay. These options decay on a daily basis because there's a finite period of time for them to become successful. So as the days go by, the value declines, which when you sell, that's what you want. You want the value to decline. Time decay works against you when you buy a debit spread because the value declines every day, and you need to be able to sell the debit spread for more than what you paid for it. But when it's declining every day, even though nothing's happening, you're losing. So there's another reason to do credit spreads and not debit spreads. So with a debit spread, I would think you would definitely not want to cover both sides because you're going to lose automatically on one side and you may lose on both sides. So that's that. And now let's talk about, I can't show you how to roll, but one of the ways you manage this, let's say, and you have to do a lot of management with Iron Condors. I don't really like Iron Condors personally because it's always going to move against you one way or the other. Even if it moves, like let's say you did both sides, you sold a put credit spread and a call credit spread, and the stock goes up. Well, now your call credit spread value is going up, so you're losing money on it. while your put side is making money, your call side is losing money. Or if the stock price goes down and moves towards your put strikes are losing money while your call strikes are making money. So it's really hard. It's manageable. What you can do is wait until the last few days of the period, and as long as it stays in the middle and you're losing that time value every day, you're still going to be okay. But if your volatility goes up while your position is on, then the prices go up and you're losing money. You need the prices to go down so that you can sell it or buy it back for less than what you sold it for. So ideally, the price of the stock would stay right in the middle or would stay above your put strikes or below your call strikes, but you also want the volatility to either stay the same or drop. You don't want volatility to go up, which is another reason you want to go into a position that starts out with high volatility, because it's more likely to go down than go up. So volatility is another big thing. We should do a video on that. So this is a quick showing of how to set up a credit spread. It's really pretty simple.